I love that after the diversity panel, we found the 3 whitest guys in the building and put them on stage. Do you feel awkward about that at all?
I feel more awkward about the fact that we all have skinny jeans on as well.
I blame the mission. All right, that's fine. Now, before we really get into this, you're the man really in charge here. And I didn't know that much about your firm before we started to talk. Or prep, I guess. So can you give us the shortest elevator pitch for Qualtrics to kind of break the ice, if you will, and kind of give the rundown about what you actually do now?
Sure, absolutely. So for those who don't know, Qualtrics, we're an enterprise SaaS company. In the simplest terms, we've developed a platform that focuses on the enterprise that makes it drop-dead simple to understand, to monitor, and to improve the vital signs of your business, which are your customers, your employees, and your market.
So you're kind of like an enterprise doctor.
Yeah.
Right. All right.
Yeah, I mean, it's all about the vital signs, and everyone wants to know what they are, and we're helping organizations get to those.
So I have a confession, actually, because when I was assigned this, I didn't know you two. And I was like, okay, I got a VC and a rando. And then we talked, and I realized you're the interesting one, and you're not. So we're going to start with you.
You figured out the Sequoia business model, I just want to tell you.
It's pretty easy. Found
Rando.
Sequoia,
I'm going to be texting Schreier, hey, Rando.
You should do that, actually. I think they appreciate that. No, so your company's very, very cool because you were founded actually out in Provo, Utah, which is, you'll note, not in Silicon Valley.
Yeah.
Is there a burgeoning tech scene in Provo?
So I think in Utah in general, I think it's taken off. You know, there was an article that was written a while back around our street in Provo, Utah. On like 1,000 feet, there's $3 billion companies with Qualtrics, a company called Vivint, and Ancestry.com, and that's pretty fascinating in Provo, Utah, to have $3 billion companies on one street. So there's a lot of movement out there, and I think there's probably 4 or 5 major unicorn companies that
I thought we weren't going to say that word.
We weren't going to say that. It came out.
Broke the no unicorn rule.
No one says unicorn on stage. That's 3 times we're done.
Huge companies that have a long runway in front of them with founders that want to go the distance, which is pretty cool.
So was there ever a moment when you're in Provo, you're working, you're building, and you thought to yourself, why the hell am I not in Silicon Valley? Or were you just kind of dancing the whole time?
Well, I think actually when we decided to take funding, one of the fears that I had was I was going to have to come to Silicon Valley to operate.
You did. You're here.
Yeah, but I take a plane and head right back, right?
True.
So I think that for us, we love everything about Utah. It's part of our DNA. It's part of our culture, and there's a lot of strengths for being in Utah, and a lot of things that I don't have to deal with from being out here as well.
And you were founded in 2002. Is that right? So I was 13 at the time. So that was a bit ago. And you had an early focus on profitability as opposed to hypergrowth, which is the current formula we all enjoy right now. People grow, they spend, they burn, but the idea is you build the top line as fast as you can. But you guys, being outside of this little odd space we call Silicon Valley, didn't have that focus. So why profitability early, and how did that feel?
So I think we are unique because we were actually able to do the best of both worlds. So we were growing at...
That sounds like a non-answer.
Yeah, well, I'll tell you. We were growing at 100%.
Okay.
Right?
Year over year?
Well, yeah, which was hyper-growth, and we were $50 million in sales, kicking off $30 million in cash.
Now you're just bragging.
Well, no, it's actually an interesting story because that was how we ran the business, and that was all bootstrapped. So we bootstrapped probably longer than any company that I've seen, and it's kind of been a 10-year, at the time, it was a 10-year overnight success.
A 10-year overnight success. I hear that a lot, actually. But I'm curious. I talk to people every day that are building companies, growing quickly, raising a lot of money. And how does having to focus on profitability that early impact your internal culture? Like, how does that manifest in how you run your business, and how does it impact your decisions you made over that 10-year overnight success period?
You really have to, kind of to be blunt, you have to, eat what you kill. It forces constraint.
Yeah.
And I think when people are constrained a little bit, they actually get extremely creative, and they're extremely scrappy.
Scrappy in terms of just hustle, or?
Everything. Hustle, you've got to be innovative. Little things like, hey, we're going to this trade show. It's like, figure if you can get the booth for free because we don't have enough money to pay for it.
This is TechCrunch. There's no free booths. Sorry.
But it's built into the DNA that we actually are running a solid business model. We need to be able to endure any type of environment out there from a financial standpoint.
2002 was right after the first tech boom bust, and then you were running right into 2008.
Yeah, and in 2007, 8, and 9 was some of the best growth that we've had in the history of Qualtrics.
Again, you brag a lot.
Alex, I think the key word there was the DNA.
Okay.
Because you have this company, and maybe it sounds like bragging, maybe it sounds like it was easy, but they had the classic start in the basement story and they started with a very small number of sales that first year. And so one of the things we've worked on over the last few years is taking that profitable bootstrap DNA and then learning the behaviors of investing aggressively in the business, which is almost the opposite of what you tend to see from startups coming out of Silicon Valley.
That was a beautiful segue, actually. Thank you. So you're in Utah from 2002 to really about 4 or 5 years ago, and then it seems like something changed. You had a different approach. That's why he's here. So I'm curious, what was the catalytic moment or the catalyst that made you guys think, all right, we can do this faster, better, bigger, stronger? Was there kind of like a lunch, or what really changed the course of your business?
I think in about 2010, 2011, we said, hey, wait a minute, this is much bigger than what we set out to do.
Yes.
Early on we were focused on the academic market and building, making sophisticated research simple, and then we started watching our user base grow. And we said, wait, there's a multi-billion-dollar opportunity here, but we've got to change some of the DNA, how we've created this business, to scale.
And that's when you picked Sequoia, essentially.
Yeah. So we sat down and we said, hey, look, we're gonna take some partners, and we won some partners, and we fortunately had the opportunity to choose who we wanted to bring into the tent with us from where we were standing, and we brought in Sequoia and Excel, and it's been great.
How did you decide on who you wanted to work with? Because he's okay, but and you have a lot of options at that level of profitability.
It's a funny story. I actually worked with Ryan's co-founder and brother, Jared, at Google.
It's a family business. Yeah.
Way back in 2004. And I think one of the other attributes of a bootstrap company is being humble, because Jared and I were meeting after he'd gone back to join Qualtrics, and we would meet over coffee to catch up personally, and he would talk about this little family side business that he joined in Provo, and completely downplaying it. And I was actually pretty surprised when I heard what was really under the hood.
So you heard the numbers, and you were like, oh my.
Yeah, I was like, well, my goodness.
Was his hair that crazy back then, or was it kind of a new adaptation?
Oh, I think he's toned it down for this stage interview here.
Okay. Before we dig into the actual amount of money you've raised, here in Silicon Valley, no one self-funds, I feel like. It's almost anathema to the idea of hypergrowth. So was there any pushback internally on your end when you decided to go out and actually find some partners and raise an assload of money? Because it's a lot of cash.
Yeah, I think there was a lot of pushback. I mean, one of the reasons why we bootstrapped for so long is because when I started this with my father, the number one rule was, hey, we'll split this 50-50, we'll blow this up, no outside funding, we're going to do this ourselves.
Right.
And so it really had to line up not only with the economically, but also the right folks on our end. And both Bryan and Ryan from Excel not only wanted to jump in the tent with us, but they saw a vision for what we were working on. And Jared was very comfortable with Bryan. They had worked together. We were both very comfortable with Excel, and the rest is kind of history. And 3 years later, I wouldn't change a thing, and I don't think many founders can go back and say that.
So you don't feel at all bad that you changed your DNA back to that point a little bit to do this? You feel comfortable with the changes inside of your business?
I think to scale a tech company, you've got to get really comfortable ripping down what you've built. And I think that was a big hurdle for us was, hey, look, if we're going to scale, if I go back through Qualtrics, it's a series of 6 different startups. And the time we took funding was just another innovation, another checkpoint that we had to go through. And we had to take what we loved about it, but we also had to rip down everything that got us to that point. And we have to continue to do that today.
So here are the numbers. You raised $70 million in May of 2012, and then $150 million in 2014. That was June, right? That's $220 million. I've never heard of a $150 million Series B. So how did you feel comfortable cutting that large of a check for such an early round, even if the company's old, I guess?
I guess it's that we're in the business of partnering with market leaders. And most of the time, you're guessing that the company's going to become the market leader, right?
Sure.
Because you're investing early on. And with Qualtrics, I mean, you heard the numbers, which almost sound like someone's bragging, and that was way back then. And you also already knew the company was the market leader. It had already become the de facto standard in automating this enormous research market. And so the question for us was more, why wouldn't you jump in with this kind of team?
So it was a very obvious investment for you guys.
It was honestly, it was pretty darn obvious, and
What was the
I
most
think we were lucky to have the long-term relationship with Jared.
Yeah.
And then I had immediate chemistry with Ryan, who is just a phenomenal CEO, and it was pretty easy, and it was really us selling hard,
Sure.
as opposed to these guys. They had any option that they wanted, frankly.
What was the core metric or the most important data point that they had that you really found to be, worthy of, like, oh, that's what I want? What really sold you?
So the most important thing for us is always the team, but in terms of the data point,
Yeah.
it was simply the financial attributes of the business, the revenue at the growth rate with the profitability. You just don't find that. I think even to this day, this is the only company at tremendous scale in the SaaS industry that is growing at the high rate that they're growing at and still generating tons of cash.
Yeah, and that's actually, I want to talk
It
about
just
that.
does not happen to B2B software, as you know.
We all read quarterly reports. We all know Box. We all know how SaaS grows and so forth. But usually it's a lot of investment, a lot of burn. And in your case, it's just been different. So what can you tell our friends here that are building companies about how you managed to pull off both hypergrowth and profitability? Because as Bryan just said, I've never seen it before. So I'm curious.
Yeah, so we kind of subscribe. We have a lot of internal principles, but one of them that's probably really helpful for entrepreneurs is we really believe in this nail it then scale it. I think a lot of organizations are trying to scale something before they've quite figured it out, which in turn generates a lot of burn. And so what we've always said is, look, let's make sure that we've absolutely nailed it, even if it's baked a little longer than maybe it could, because we'll be able to scale very quickly. So a great example of that is when we went over to Europe, we had $200,000 to $400,000 a quarter coming in from Europe from a team that was selling at night in Utah over there. And so when we went over there, having 130 customers over there already, we knew exactly the model. So in a year, we were able to scale. We opened up our Dublin office, and we have 100 employees over there because we went forward with 100% confidence, as opposed to trying to figure it out on the fly.
The other thing I would add, if I may, is that, and this is really helpful, I think, to a Silicon Valley audience, the company has best-in-class products, and so there's been a ton of innovation there. The other area of innovation, which was really clear when we were looking at Qualtrics in the initial get-to-know-you process, was that there's been a tremendous amount of innovation on the go-to-market side. So I think it's really important to remember that you don't just innovate on product, you also innovate on go-to-market, and I would say that this is absolutely the most innovative sales force in the country right now, and no one does it the way Qualtrics does.
I have absolutely no idea what that means. So when you innovate on the go-to-market, what does that actually manifest in?
Yeah, so I think historically, if you were a great product company or a great engineering company, then you kind of get away with a lot. You could be an expert, or you could be best in class at either engineering or go-to-market or sales. And I think next-gen companies, what you're finding is we all have smart engineers. We all have a ton of money. If you've got a pulse, you've got money right now. And
is that true?
Pretty much.
Pretty much true, yes.
But you've got to be best in class in both. And you're watching even the great consumer companies that had a ton of virality now have to figure out their go-to-market. And so I think you've got to be best in class in both areas. And that's kind of how we structured our organization. We think we've got the best software team and development team in the world, and we're also backing that with one of the best go-to-market teams in the world. And I think that's absolutely mission critical in the future.
Yeah, by go-to-market, I mean sales and marketing.
Yeah, right. How you approach the market.
And where you the evidence that this is an innovative and probably the most efficient sales and marketing machine out there is in that cash flow margin that the company has. That's where it shows up, because the reason most SaaS companies are not turning a profit at this stage is because they have to invest tremendous amounts of capital in sales. This company does it different, and that's where the evidence is.
People forget how expensive SaaS revenue really is.
Yep.
I mean, building that ARR is incredibly cost inefficient in a way. All right, we only have so much time, so quickly, did you raise too much money, or are you actually comfortable with where you're at right now capital-wise?
So I think we're super comfortable. I mean, we've been very thoughtful, probably a lot more thoughtful than most groups as we've gone through the fundraising. Now, I'm sure we'll raise more as time
You heard it here first.
as time comes on. But I think we're perfect for where we're at.
Okay. We mentioned the U word earlier in this talk, and there's been discussions among VCs and entrepreneurs that I know about people trying to raise at a certain valuation threshold to get that label, if you will. It's almost like a vanity metric now. And the phrase that I hear is, your evaluation, my terms. So I'm curious, when you raised that $150 million, did you at all have a minimum threshold or floor in mind, or was it just kind of where things landed? And please don't lie.
Look, I mean,
They've never taken the highest offer.
Yeah. I mean, even
Okay.
when we brought in Excel and Sequoia the first time, we raised it probably $100 million less than what we could have raised at.
And that was the 70.
That was a 70
Okay.
million. Because we wanted to get the right partners in the tent. Then the second time, I mean, this last fundraising round that you mentioned, I did 2 presentations, and we closed it in a week. So, and both groups were interested, and I wasn't trying to maximize on value. For me, it's always been about where can 1 and 1 equal 5, and we're trying to create a multi-billion-dollar company here, and to do that, we want to get the best people in the world in the tent. I think a lot of people are way too focused on what this means publicly, because a lot of people come up and congratulate you. I've gotten a little bit of slack because I've said, congratulating me on raising funding is like congratulating me on taking out a mortgage. I mean, when was the last time you walked up and said, hey, that was one hell of a mortgage you just took out?
Great.
The bank has a lot of confidence
I got a
in
great
you.
rate, man. My bank totally stood up for me. It's fantastic.
So
I now
I mean,
own
no
4
one used,
square feet.
no one used to congratulate me at all when we were in the basement kicking off a ton of cash. But the second we raised $70 million, everyone's like, you've arrived. And it's like, well, what a...
No, we've been here the whole
Actually,
time.
that was a hell of a lot harder
Right.
to do than
Yeah,
this. I mean, I locked this up
You
in
make-
a week. It took
you-
me 10 years
You
to
make
build that.
fundraising sound so easy. It's actually a little harder for most
It's so
people.
hard to get perspective in Silicon Valley because the echo chamber that we're in. And this is just yet another benefit of the bootstrap strategy where you spent that time in the basement with no money. Very few companies here have done that with no money. And then it helps inform them and just maintain this very long-term view when any major decision for the company comes up.
But a lot of great companies were founded in the garage. I mean, just like Apple and HP were really founded in these bootstrapped situations. Do you think that's a material advantage or more of a risk?
Do I think? So I actually do think that setting the DNA early of having to sing for your supper and building a real business model from the start is very, very important. Huge advantage to many companies, from the companies you mentioned to Yahoo. Another company we work with, Dropbox, was self-sustaining from very early on. And we just love that attribute. GitHub is another company we're partnered with, has similar.
Did you say sing for your supper?
Sing
You
for your
use
supper.
more old-timey cliches than any VC that I know. All right, we're out of time, but last question. How long until I'm seen in S1? Again, no lying.
Yeah. So look, I think it's definitely in the plans. As we look at what we're trying to do, that's gonna be part of it. We're preparing and we're acting internally when we have our board meetings. Everything. I mean, it's the end of the quarter right now. We're acting like a public company. The good thing is one of the things about being an entrepreneur is I wanted to be able to write our own story, and I think Qualtrics has a lot of runway, so we can go out when we need to go out. And the whole goal is we want to be able to tell the story, not have someone tell it for us. So we'll go out when we're ready.
All right. Well, thanks guys for coming in.
All right. Awesome.
Thanks so much, Alex.
Thanks.